In 1975, an engineer built the first digital camera in history. His bosses looked at it, said, "That's cute," and told him to never mention it again. That engineer worked for Kodak. 25 years later, a company called Blockbuster had a chance to buy Netflix for $50 million. They laughed the founders out of the room. Both of these companies were once worth billions. Both of them controlled their entire industry. And both of them are gone. Not because they didn't see the future coming. They built the future themselves in a back room and then buried it. This is the story of how two empires destroyed themselves with their own inventions, and the one decision made in a boardroom that both of them share.
To understand how big Kodak fell, you have to understand how big Kodak was. For most of the 20th century, if you took a picture, there was a 90% chance it was on Kodak film. At its peak in 1976, Kodak controlled 90% of film sales and 85% of camera sales in the United States. The company employed over 145,000 people. It wasn't just a business, it was a piece of American culture. Kodak moment wasn't a slogan, it was a phrase people used in real life. Family Christmases, graduations, weddings. Kodak owned the memory industry. The company's stock was considered one of the safest investments in America.
It sat inside the Nifty 50, the blue chip stocks everyone's grandparents held. Kodak built its empire on a simple, brutally profitable model. Sell the camera cheap, sell the film and the developing forever. Every roll of film, every photo printed at the drugstore, that was pure recurring revenue. By the 1990s, Kodak was pulling in over $16 billion a year. It funded research labs, chemical plants, entire towns built around its factories. Rochester, New York was practically a company town. Kodak was so dominant that competitors weren't really trying to beat them. They were trying to survive next to them. This is the company that then invented the thing that killed it. In 1975, a 24-year-old engineer named Stephen Sasson was given a strange assignment. His manager asked him to see what could be done with a new type of image sensor called a CCD. Sasson spent about a year in a lab, cobbling together spare parts. What he built looked nothing like a camera. It was the size of a toaster, wired together with cassette tape and lenses from a Super 8 camera. It weighed almost 4 kilograms. It took 23 seconds to capture a single black and white image at 0.01 megapixels. But it worked. No film, no chemicals, no darkroom. Just a picture stored as data that you could play back on a television. Sasson brought it to Kodak's executives for a demonstration. He recorded a photo of a lab assistant and played it back on a TV screen in the room. The executives were, in his own later words, charmed but nervous. One of them reportedly asked, "Why would anyone ever want to view their pictures on a television?" Sasson answered honestly, this technology could eventually replace film entirely. That answer is the entire problem in one sentence. Kodak made roughly 70% of its profit from film and the chemicals used to develop it. A technology with no film and no chemicals wasn't an opportunity to them. It was a threat to the machine that was printing money. So Kodak did something that companies do more often than you'd think. They patented the digital camera, filed it away, and kept selling film. Internal researchers were reportedly told, in effect, "Don't talk about this outside the building." It wasn't that Kodak's leadership was stupid.
Many of them understood exactly what digital imaging could become. That was precisely the problem. Fully committing to digital meant cannibalizing a business generating billions a year in near pure profit. Executives ran the math, and the math said, digital cameras don't need a film reorder every month. No film reorder meant no recurring revenue. And no recurring revenue meant no Kodak as they knew it. So instead of leading the digital transition, Kodak spent the next 2 decades slow walking it. They released digital products, but always in a way that protected film sales first. Marketing budgets for film dwarfed marketing budgets for the digital line. Executive bonuses were tied to film performance well into the 1990s. Meanwhile, Sassen's original patent just sat there, technically owned by Kodak, practically ignored. Competitors like Canon, Sony, and later smartphone makers had no film business to protect. They had nothing to lose by going all in on digital.
By the early 2000s, digital cameras were no longer a novelty. They were cheaper, faster, and didn't require a trip to the drugstore. Kodak's film sales, the engine of the entire company, began falling off a cliff. In 2003, Kodak finally announced it would stop investing in film cameras for the US and European markets. It was roughly 28 years after Sassen's invention. By then, the head start was gone. Kodak tried to pivot hard into digital cameras and printers, but the market was already crowded. Then came a second wave that Kodak also underestimated: the smartphone. Once phones could take decent photos, standalone digital cameras started dying too. Kodak's revenue collapsed from over $16 billion in the mid-90s to around $6 billion by 2011.
The stock, once a blue-chip holding, was delisted from trading above $1 a share. On January 19, 2012, Eastman Kodak filed for Chapter 11 bankruptcy. A company that once employed over 145,000 people emerged from bankruptcy as a fraction of its former size. Today, Kodak survives mostly licensing its brand and old patents. Ironically, one of its biggest post-bankruptcy paydays came from selling off a pile of those old digital imaging patents for around $525 million. The invention they buried in 1975 ended up being worth more than the company that buried it. Stephen Sassen, the engineer who built that first camera, was eventually inducted into the National Inventors Hall of Fame. Kodak, the company he built it for, was not around to see it. Okay, quick pause. If patterns like this are as fascinating to you as they are to me, this is basically what this channel is built around. So it genuinely helps if you hit subscribe on Compound Economy before we keep going. All right, back to it. Because Kodak wasn't even the most painful version of this story. Rewind to the late 1990s, and there was no bigger name in home entertainment than Blockbuster. At its height, Blockbuster operated over 9,000 stores worldwide. It employed roughly 84,000 people. Friday night in most American towns meant the same ritual. Drive to Blockbuster, walk the aisles, argue about what to rent, maybe grab some candy at the counter. The company was valued at around $5 billion at its peak. Blockbuster's business model looked simple on paper. Rent physical movies and games, charge a fee per rental, and charge a late fee if you forgot to return it.
That late fee piece mattered more than people realize. At its peak, late fees alone were bringing in an estimated $800 million a year. That's not a side revenue stream. That was close to 16% of total revenue. Blockbuster had essentially built a second business model out of customers' forgetfulness. The company crushed smaller video rental chains through sheer scale and store count. New releases, snack aisles, membership cards. Blockbuster wasn't just renting movies. It was the default Friday night. By 2000, Blockbuster looked untouchable. Then a small DVD by mail startup with under 300,000 subscribers came knocking.
In 2000, Netflix was tiny, unprofitable, and struggling to grow. Co-founders Reed Hastings and Mark Randolph flew to Dallas to meet with Blockbuster's leadership. Their pitch was straightforward. Netflix would run Blockbuster's online brand, and Blockbuster would promote Netflix in its stores. The asking price for the whole company was $50 million. Blockbuster's CEO at the time, John Antioco, reportedly found the offer almost laughable.
Netflix, at that point, was losing money and had a fraction of Blockbuster's customer base. From inside a $5 billion company, $50 million looked like a rounding error, not a threat. Blockbuster passed on the deal. The reasoning wasn't irrational on its face. Mail-order DVD rental was a niche. In-store rental was still the overwhelming majority of the market. But the meeting revealed the same blind spot Kodak had 2 decades earlier. Blockbuster's empire was built on physical stores and late fees. A subscription model with no due dates and no late fees didn't fit that machine. It threatened it. Late fees were roughly $800 million of pure high-margin revenue. A no-late fees competitor wasn't just a new option for customers. It was a direct attack on Blockbuster's most profitable line item. So instead of adapting, Blockbuster kept optimizing the model it already had. More stores, more candy aisles, more late fees. Netflix, meanwhile, kept growing quietly in the mail-order shadows. By 2004, Netflix had over 2 million subscribers and was starting to threaten Blockbuster's core business directly. Blockbuster finally reacted, years too late, by launching Blockbuster Online and eventually eliminating its own late fees. That move alone reportedly cost the company around $400 million a year in lost late fee revenue. It was the right idea, executed years after the moment it would have mattered. Internally, Blockbuster was also carrying a mountain of debt from its earlier spin-off from Viacom. That debt load made it much harder to fund an aggressive pivot into streaming and online rental. Netflix, unburdened by store leases or that debt, kept iterating. In 2007, Netflix launched instant streaming. Blockbuster was still primarily a brick-and-mortar rental chain with a bolted-on online arm. The gap that had started as "we'll pass" onto $50 million was now a gap in entire business models. By 2010, Blockbuster was carrying around $900 million in debt. Store traffic was falling as streaming and mail-order rental ate into rentals. On September 23, 2010, Blockbuster filed for Chapter 11 bankruptcy. At the time of filing, the company still operated thousands of stores, but the core economics were broken. Dish Network bought Blockbuster's remaining assets out of bankruptcy in 2011 for roughly $320 million. That number alone tells the story. A company once worth $5 billion sold for a fraction of that. Dish shut down the vast majority of the remaining corporate stores over the following years.
By 2019, only a single independently owned Blockbuster location remained in Bend, Oregon. It's still open today, now more of a nostalgia landmark than a business. Meanwhile, the company Blockbuster could have bought for $50 million was by the 2020s worth well over $150 billion. Reed Hastings later said in interviews that he didn't even think Blockbuster took the meeting seriously. To them, Netflix wasn't a competitor. It was barely a rounding error. $50 million versus $150 billion. That gap is one of the most cited what-if numbers in business history.
Put these two stories side by side, and the coincidence stops looking like a coincidence. Kodak invented the digital camera and buried it because it threatened film profits. Blockbuster was offered the future of its own industry and passed because it threatened late fee profits. In both cases, the company wasn't blind to what was coming. They saw it clearly enough to build it, or clearly enough to be offered it directly. The failure wasn't a failure of vision. It was a failure of incentives. Kodak's leadership was rewarded for protecting film revenue, not for cannibalizing it.
Blockbuster's leadership was rewarded for protecting store and late fee revenue, not for replacing it. When your entire bonus structure, your entire company culture is built around defending the current cash cow, the correct long-term decision looks, in the short term,
like self-sabotage. Economists have a name for part of this: the innovator's dilemma. Successful companies often fail specifically because they keep doing what made them successful, even after the market moves. It's not that Kodak and Blockbuster's executives were incompetent. Many of them were sharp, experienced operators. But they were optimizing for protecting a 50-year-old business model instead of building the next one. And the market does not wait for permission. Every dollar Kodak spent protecting film sales was a dollar not spent winning the digital camera race. Every year Blockbuster spent defending late fees was a year Netflix spent building an unbeatable subscription habit. The lesson isn't always chase every new technology. Most new technologies fail. Most pivots are wrong. The lesson is narrower and sharper than that. When a threat to your core business also happens to be your own invention or is handed to you directly, that's usually not a coincidence, and it's usually not a small threat. It's the market telling you exactly where the next 20 years are headed. Kodak had a 25-year head start on digital photography and let it rot in a filing cabinet. Blockbuster had a literal invitation into the streaming era for $50 million and said no. Both companies had the resources, the talent, and the timing to win. What they didn't have was a structure that let them act against their own short-term interest. That's the real bankruptcy that happened years before the paperwork.
If you want more stories like this, breaking down exactly how empires like these get built and how they fall apart, subscribe to Compound Economy.